13%, that is a real yield available right now in four different corners of the market. And here is what almost nobody checks. If the share price paying you that 13% fell 15% over the same year, you did not earn 13, you lost 2. And you paid tax on the way down. High yield and high return are not the same thing, and the gap between them is where income investors quietly go broke. Before we begin, the disclaimer. I am not a financial advisor, and this video is for education and entertainment only. Nothing here is investment, tax, or legal advice, and nothing is a recommendation to buy or sell anything. Investing involves risk, including the loss of your capital. Past performance does not guarantee future results. I may hold some of the assets discussed. Always do your own research and consult a licensed professional before making any decision. And welcome to the channel. Here we go deep. We don't do surface level tips or hot stock picks. We break down the real mechanics that move markets and the money inside them. Today, the four big income machines, why they pay so much, and the single discipline that separates real income from a slow bleed. Scroll through high income investments and you will find yields that make a savings account look like a joke. 8%, 10%, 13%, and beyond. They cluster in four specific corners of the market: REITs, business development companies, master limited partnerships, and mortgage REITs. The yields are real. But here is the rule this whole video is built on. A high yield is not the same thing as a high return. Confusing the two is one of the most expensive mistakes an income investor can make. First, why do these four pay so much more than a normal company? It is not generosity and it is not magic. It is structure. All four are pass-through entities. In exchange for being largely exempt from corporate income tax, they are required to pay out the vast majority of their income to shareholders, often 90% or more. A normal company keeps its profits and reinvests them. These structures are legally built to hand the cash straight to you. The high yield is a feature of the plumbing, not a sign of a superior investment. Let us take them one at a time. First, REITs, real estate investment trusts. They own income-producing property, apartments, warehouses, data centers, shopping centers. You collect a slice of the rent. The best of them have raised dividends for decades. One famous REIT has paid monthly dividends for over 50 years and hundreds of consecutive months. REITs are the most established of the four, but they are sensitive to interest rates and to the health of the property types they own. Second, business development companies, or BDCs. Think of them as private equity and private lending for everyday investors. They lend money to or take stakes in small and mid-sized private companies that cannot easily borrow from a bank. The interest they collect funds big yields, often 8, 9% or more. The risk is credit risk. In a recession, the small companies they lend to are the first to struggle, and defaults can hit the BDC's income and its book value at the same time. Third, master limited partnerships, or MLPs. These mostly own energy infrastructure, the pipelines and storage that move oil and gas around the country. They often behave like toll roads, collecting fees on volume rather than betting on the price of oil. That can make their cash flow steadier than you would expect. The catches are real, though. They are tied to the energy sector's fortunes, and they come with genuinely messy tax paperwork that can complicate your return. Fourth, and the most dangerous of the group, mortgage REITs, or mREITs. Despite the name, they do not own buildings. They borrow money short-term and use it to buy mortgage-backed securities that pay long-term. Their entire profit is the spread between those two rates. When that spread is wide, the yields can look astonishing, well into the teens. But when short-term rates rise or the spread compresses, their income gets crushed and their share prices often grind lower for years. This is the corner where the biggest yield traps live. And there is one more thing about mortgage REITs specifically that explains why their yields are so extreme and why their long-term returns so often are not. They are leveraged. A mortgage REIT borrows short-term money, buys longer-term mortgage assets, and pockets the difference in rates. That spread is thin, so to make it meaningful, they multiply it, often borrowing 5 to 8 times their equity. Leverage cuts both ways. When the gap between short and long rates compresses, or when rates move violently, the book value of the portfolio can be destroyed far faster than the distributions can ever make up. A double-digit yield on an asset that keeps losing book value is not income. It is a slow liquidation with good marketing. Now, the heart of it. A high yield can mean one of two very different things. It can reflect genuine, durable cash generation, a healthy business handing you real income, or it can reflect the collapsing share price, where the yield only looks high because the denominator fell. Remember, yield is just the dividend divided by the price. If a stock halves, its yield doubles overnight, even though nothing got better. A soaring yield is just as often a warning siren as it is an opportunity. Now, the mechanic that catches more income investors than any other, because it is genuinely hidden. Not every distribution is profit. Some of it is classified as return of capital, which means exactly what it sounds like. The fund is handing you back your own money. It feels identical when it lands in your account, but it is not income the investment earned. It is a refund of what you put in, and it quietly reduces your cost basis. A fund can advertise a stable, generous distribution for years, while a meaningful slice of it is simply your own capital coming home. You can check this. Funds publish a breakdown of what each distribution actually consisted of. Almost nobody reads it. Let us make that concrete because the arithmetic is what convinces people. Two funds both advertise a 13% yield. Over 1 year, Fund A holds its share price steady and pays that 13% out of money it actually earned. Your total return is 13%. Fund B pays exactly the same 13%, but its share price falls 18% over the same year. Your total return is -5. Same headline number on the screen, an 18-point difference in what actually happened to your wealth. And the investor in Fund B may well have felt richer the whole time because the cash kept arriving on schedule. So, how do you tell a real income payer from a trap? You check whether the payout is actually covered. Look at the payout ratio. Is the company paying out more than it earns? Look at cash flow coverage. Does real cash actually fund the distribution? Look at the balance sheet and debt load because leverage magnifies trouble. And look at the dividend history through past downturns. Did it hold or did it get slashed when things got hard? A durable yield survives a bad year, a trap does not. So here are the specific warning signs, and these are checkable in a few minutes. 1. A yield dramatically higher than others with the same structure. If every comparable business development company pays 9% and one pays 16%, the market is pricing in a cut, not offering you a gift. 2. A payout ratio above 100%, meaning the company is distributing more than it earns. 3. A history of distribution cuts, especially during the last downturn. 4. A share count that keeps rising, which can mean new investors are funding the payments to existing ones. And 5. A large return of capital component in the distribution breakdown. Any one of those deserves an explanation. Two or more together is usually the market telling you something. But the ultimate test is the one we keep coming back to on this channel: total return. Add the price change and the distributions together over several years and compare it honestly to a plain index fund. If a 13% yielder has been bleeding so much share price that its total return trails a boring index, then that yield was an illusion. You were being paid your own capital back while feeling wealthy. The yield is the bait, total return is the truth. And there is a cost that almost never appears in the yield comparison, which is tax treatment. These structures generally do not pay the lower qualified dividend rate that ordinary company dividends enjoy. Distributions from real estate trusts and business development companies are largely taxed as ordinary income at your normal rate. Master limited partnerships are messier still. In the United States, they issue a partnership tax form rather than a standard dividend statement, which complicates filing and can cause problems inside tax-advantaged accounts. And for investors outside the United States, Partnership structures frequently carry punitive withholding that can take a large bite out of the headline yield before it ever reaches you. A 9% yield taxed as ordinary income can easily land behind a 6% yield taxed favorably. Always compare after tax, not before. To be fair, these four are not villains. For the right investor, they are genuinely useful. If you actually need to live on income now, a carefully chosen, high quality REIT, BDC, or MLP can deliver real spendable cash that a growth fund simply cannot. The key words are high quality and chosen. The danger is never the structure itself. It is reaching blindly for the single highest number on the screen and assuming the yield will simply keep arriving. So, a simple framework with nobody telling you what to buy. First, understand which of the four structures you are actually holding because their risks are completely different. Second, never judge any of them on yield alone. Always pull the total return over several years. Third, demand coverage, a payout the cash flow can actually sustain. And fourth, size them as an income sleeve, not your whole portfolio, so a single dividend cut can never break you. So the checklist, and this takes about 10 minutes per holding. 1. Pull the 5-year total return, price plus distributions, and put it next to a plain index fund. If it trails badly, the yield was never the point. 2. Check the payout ratio and whether real cash flow covers the distribution. 3. Read the distribution breakdown and find out how much of it was return of capital. 4. Look at the share count over 5 years. If it keeps climbing, ask what those new shares are funding. And 5. Look up what happened to the distribution in the last serious downturn, because that is the only real stress test you have. To wrap up, REITs, business development companies, master limited partnerships, and mortgage REITs pay big yields because of how they are structured, not because they are better investments. Some are durable income payers, others are yield traps where a falling price inflates the headline number. The only way to tell them apart is coverage and total return judged over years, not the yield on the screen today. None of this is a recommendation about any specific security. That is for you to research. If this changed how you look at a yield number, do me one small favor. Tap like. It genuinely helps more investors find this. Share it with someone who is about to buy something purely because of the percentage next to it. And subscribe because we do this properly every week. We do the digging so you do not have to guess. See you in the next one.